Welcome to another episode of the Financial Medicine Show. In this episode, we're going to be talking about credit scores and what makes up a credit score. Stay tuned. Hi everyone, I'm Min and this is Elisa. We're here to talk to you about personal finance and medicine. Today's episode is all about credit score. According to the report on the Economic Well-Being of U.S. households, about 83% of U.S. adults had a credit card in 2020. The average number of credit cards that an American have is 3. And there are different types of credit cards companies out there, including Visa, MasterCard, American Express, and Discover. When I first got a credit card, I didn't know too much about a credit score and what goes into a credit score. So can you please describe what is a credit score?
Sure. So a credit score is a number that is given to you to rate your credit risk. It can help many creditors determine different things. For example, they can decide what terms to offer you. This is also including what interest rates to offer you. And having a high score can benefit you in many different ways. For example, it can make it easier for you to get an apartment, get a loan, lower your insurance rate, or have better interest rates overall.
What is the range of a credit score and what is considered a good credit score if I'm trying to maximize it out and get the best score that I can?
Sure. So the two most popular credit bureaus is FICO and Experian, and they both have credit score ranging from 300 to 850. Generally speaking, a score above 700 is considered good and will offer you the best rates possible.
So what makes up our credit history? How is the score determined?
Your credit is determined by your credit report. So this can include both negative and positive remarks. The most influential one is payment history, comprising of 35% of your score. Second one is amounts owed. This is 30% of your score. And credit history comprises of 15% of your score. And the last two is credit mix and new credit, both comprising of 10% of your score. So let's take a deeper dive into payment history. This is checking to see how you paid your creditors on time. It generally composes of 3 different considerations. One is on-time payments. Have you made on-time payments with your different loans? Paying on time is always a good thing, and this shows up as a positive remark onto your credit report. Second is late payments. These actually negatively impact your score. When you get a bill that is due and you pay that bill 30 days past the due date, usually your lender or your credit card company will report to the bureau that you've made a late payment, and this affects your credit report and credit score negatively. And a good thing to consider in terms of late payments is that as long as you're having those bills that are past due or overdue, for example, if I had a payment due 2 months ago and I continue to not pay that bill, it will continue to produce negative remarks onto my report. And the third consideration is public records. So any filing of bankruptcy can negatively impact your score.
If I make a late payment, maybe it's an accident, how long does it actually stay on the credit score history?
According to the Fair Credit Reporting Act, any negative impact or late payments can stay onto your report for as long as up to 7 years. And again, as long as you continue to have these late payments and you always continue to overdue on it, it will continue to produce these negative remarks onto your credit report and continue to decrease your credit score. The next most important category is amounts owed. Amounts owed or your credit usage is determined by how much you've utilized in your credit. So this is mostly determined by credit utilization ratio. This takes the amount you've used divided by the sum of all your credit limit. So for example, let's say I have a credit card that has $10,000 in limit and I purchased and did stuff and utilized $2,000 of that. We can take $2,000 divided by $10,000 to produce our utilization rate or ratio of 20%. And generally speaking, most bureaus and credit score companies consider a utilization ratio of 30% and under to be positive. But most people with really high scores above around 800 generally use less than 10% of the utilization ratio.
That's really interesting. When I think about credit cards and paying off credit cards, I always thought that the more you purchase and the more you spend and then you pay it off in full, the better it's going to be for your credit score. But what you're saying is that instead of using 100% of your credit limit, if you use 30% or less and don't use up the whole thing, that's actually going to improve your score?
Yes, so that's actually a common myth. Many people think that once you open up a credit card, you have to continue to use it a lot, and get up to like 100% of the utilization ratio, but that actually makes your credit score worse. And even just having that credit card open and not using it any month will actually produce a really good score, because every month that you hold that credit card for, so let's say for January, February, March you hold it, your credit card company will actually report to these bureaus and say, hey, this person had a credit card and they haven't missed any payments, even if you didn't have any payments. That produces a good rate. And I want to say that there are two different ways that you can lower your utilization ratio. One is to pay down your credit card monthly and not carry that balance month to month.
Mhm.
And two, if you do notice that you need a higher or you continue to use a lot of it, you can try to request for an increase in your credit limit. And the next category we have is credit history. This can be determined by generally two different methods. One is to see how long or what is your longest age of your account. So in this scenario, for example, let's say I have a credit card I opened up 4 years ago and I just opened a new credit card. My longest account would be considered that 4 year that I've had with that one credit card I opened. And another method that people use to calculate is your average age of all your accounts. So we could take that by adding up all the different ages and dividing by total counts. So for this scenario, my average age would be around 2 years because I just opened up that new account. And the last two categories that make up each both 10% of your score is new credit and credit mix. When you apply for a new credit, submitting this application can lead to a hard inquiry. A hard inquiry is a record of a fact that someone went into your credit report and took a look at it to see if they can determine whether or not to give you that credit. This can actually cause your credit score to be worse because they think that they tend to create a more risk for lenders to see that you are trying to open more accounts and you're looking around. But we need to also keep in mind that opening new account can actually not lower your account, but there may be times when it can create a positive remark on your credit score, because when we look at the next point, credit mix, having different types of credit helps your score. Different type of credits can include, for example, credit card. This is a category, student loans, mortgages, auto loans, as well as personal loan. So if you have just only credit cards, you may want to consider getting another type of loan to improve your score.
So thank you for going into all the different components of what makes up a credit score. And if I'm a complete beginner and I'm just got a credit card, can you summarize succinctly what are the most important aspects to keep in mind out of everything that you talked about? Can you give us a quick summary of what we should know about?
Of course, I would say for the most absolute beginner and you want to get that good score, always pay on time and always pay your balance on full. This will help you produce that good payment history, which is very influential, and allow reporters to see that you're trustworthy to lend to. In addition, try not to use your credit card too much. Try to get that credit utilization ratio under 30%. And since this is your first card or your newest card, I would say try to hold that card for as long as possible and not close it so you can have a long credit history.
Well, thank you so much. That's all we have for today. If you guys have any questions about credit scores, go ahead and comment down below. We're going to be talking more about credit scores later on in future episodes, but if any questions, please let us know and we'll catch you on the next episode. Bye-bye.